You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Alrighty, welcome back everybody. Earnings season, here we go. Hey Hamish.
Yeah, it's getting started. There's always not that many companies, that we're interested in right at the start.
Yeah.
But it's great to be upon us again. And guys, if you have any companies that you want us to take a look at over the next few weeks, because a lot of the podcasts over the next few weeks will be looking at these companies reporting earnings, then head over to the YouTube version of the podcast, find the latest one, and just leave which companies you want us to cover there, and we'll do our best to please as many people as possible.
For sure. I think in the next 2 weeks, it'll really hot up. I mean, there's a couple that have already reported, but I think the early ones to report are like banks and those sort of companies. So
yeah, it is always the banks. Yeah.
Not particularly thrilling. I don't particularly like to talk about banks.
No. Yeah. I think a lot of the tech companies will be reporting in a couple of weeks' time. I know that Netflix is reporting while today, a little bit later today, while we're recording this. So it will be out by the time the podcast is out, which is a little bit unfortunate.
Annoying.
But we'll have a look at them next week. Yeah, and I know that Facebook, just because it's one of my investments, they're reporting at the end of July. So a little bit while to wait for Facebook, and I think Google reports in the same week as them. So we'll have to wait for those. But yeah, if you have any that you want us to cover, go ahead and leave it as a comment on the YouTube version of the podcast, and we'll do our best.
Yeah. And it's a bit of a PSA as well, because if you start seeing your share prices of your investments go up or down over the next little while, make sure you go and check the earnings reports. Go listen to the conference calls, go read about what they've been up to, how they've been impacted over Q2. I think it's likely that we'll probably see quite a bit of turbulence just from many individual companies, because Q2 that's really, especially what we're talking about when we're looking at US-based companies, that's when the virus really shut the whole economy down during Q2. So yeah,
this is probably going to be the most interesting quarter. Q1 was interesting, but what did we get? January, February, March for most companies. So we didn't really see too much of an impact of the virus. Now we're going to see April, May, June. For most companies, that is. Some companies choose to go against the grain and do something annoying.
Make our lives difficult.
Yeah, exactly. Yeah. But this will be a quarter that will be severely impacted by a lot of businesses. So it will certainly be interesting to see which ones are handling it okay and which ones are not handling it as well. But we will see. We do have one earnings to talk about today, though, don't we?
Yeah, we do. But let's do our sponsor first.
Yes. So today's episode is sponsored by Sharesight. So Sharesight is an application that you can use to track the performance of your stock portfolio. And it's fantastic for keeping track of your capital gains, dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then the main reason why I use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out things such as capital gains, dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT. And if you also use that link, you can get 4 months off when you sign up to a yearly subscription. So particularly because it's tax time at the moment for those in Australia and some other countries, go check that out. There's a free plan. You can use it for your entire life for free, or you can sign up to a yearly subscription and save 33%, not 25%.
Yeah, not 25. Definitely not 25.
Some people
so we do
joke.
have... Yeah, it's just going to be ongoing. It's going to be going for a long time, that one. Anyway, we did have a couple of earnings reports to talk about today. But first things first, I wanted to get into some breaking news this morning, is that overnight, there's been just a massive Twitter hack. And it's caused Twitter to shut down all of their verified accounts. How crazy is that?
Yeah, I'm going to be honest. I was very scared when I saw this headline. It's always terrifying to see that there's these big high profile accounts that are being hacked.
It's so easy. I mean, there were a lot of people. Anyway, I'll read it. It says here, Twitter has locked down all verified accounts after dozens of them were hacked in a widespread Bitcoin scam. Twitter confirmed it was taking steps to fix the massive hack and advised its account holders they might not be able to tweet or reset their password until it had fixed the problem.
Wow.
Tesla boss Elon Musk, Amazon boss Jeff Bezos, and rapper Kanye West were three of the many accounts hacked by scammers trying to dupe people into sending cryptocurrency Bitcoin in the hope of doubling their money. That's...
I saw the Bill Gates one and it was just like, it's time for me to give back. And then it was like, send me Bitcoin to this address and I'll send back double the amount. It's kind of scary because I know that, I mean, for some people you wouldn't fall for that, but a lot of people would, and especially when it's coming from a verified account of someone who's so high profile.
Exactly.
It's very scary. But I think the main thing here is that Elon, what is he going to do for the next 24 hours while his accounts, while he can't tweet? He's going to be itching to...
Steam coming out of his ears. His brain will explode.
Yeah, I wonder, was Donald Trump's account hacked? Is he still on his...
I don't think so.
Because he would have lost his mind. He would have probably gone on a rampage against Twitter if he couldn't tweet for 24 hours. Wow.
Yeah, that would actually, it says here, was that Microsoft founder Bill Gates, former US President Barack Obama, and his former Vice President Joe Biden, Kim Kardashian, billionaire Warren Buffett, Mike Bloomberg, also victims of the scam. What the hell? Buffett?
Oh, that would have been hilarious. I presume the post isn't there anymore, but it would have been funny to see the comments on that being like, Buffett, what are you doing?
The crazy thing to me is he has a Twitter account.
Yeah, I don't think he uses it. But
I was going to say,
it's just
follow him.
It's just hilarious because he's so anti Bitcoin as well. Be the last thing that he would post about.
I hope that someone got a screenshot of that.
Yeah,
that would have been hilarious. So. It's time for me to give back. Please send $1,000 of Bitcoin to this address and I'll send you back double.
Oh dear.
Wow, that's crazy. Yeah. But it seems like Twitter have jumped on it straight away. But like what you said before, it's quite concerning that that all these really high profile and in many cases very trustworthy people were able to have their accounts hacked, and I can't imagine how many people would have fallen for it, because a lot of these people you do generally just tend to trust.
Yeah.
Hopefully people can see, obviously, that they're asking you to send Bitcoin to a random address. Hopefully people can just identify that as a scam, but I'm sure there will be many, many people out there that did not identify it as a scam.
Yeah, I think I saw that. I read one article and they said that they could verify that there was at least $110,000 sent to that Bitcoin address.
Wow.
So there was a substantial amount of money made by these scammers. This whole thing just scares me. I think because we rely so much on our online presence and these social accounts that it would be devastating to see this happen. And it has happened to people in the past where they have a big presence on Twitter or something, or Instagram, for example, and that's, a substantial amount of their business, and then it gets hacked. And if you're a very high profile person like these people, Twitter's going to be right on it, and they're going to make sure it's fixed and that you get your account back. But for other people, you're not so lucky sometimes.
Yeah. So there you go. Watch this space.
Yeah.
Twitter might not be so exciting over the next few days.
Yeah, I saw the stock price went down 5%. So,
oh, did it?
Yeah.
There you go. Well, it seems like probably that shouldn't be very surprising. It seemed like it was quite a significant breach.
Yeah.
So there you go.
Not good.
Anyway, yeah. So that's that story. Watch this space. Hopefully, those account holders get their accounts back soon. All right, let's move on into some earnings. So let's talk about Delta Airlines. You want to talk about Delta?
Yes. Yeah.
Pretty worrying kind of earnings, if I'm honest. I only kind of read through a couple of Yahoo Finance articles. I haven't delved too much in depth, but this is what they had to say. Delta Airlines on Tuesday reported a steep plunge in second quarter revenues and profit as the COVID-19 pandemic hammering the travel industry ravaged the company's bottom line. Here were the main results from the report compared to consensus estimates compiled by Bloomberg. So their revenue came in at just $1.2 billion, which is pretty crazy, versus $1.43 billion that was expected. Loss per share, $4.43 versus $4.22 expected. Net income loss, $2.81 billion versus $2.66 billion expected.
Whoa.
So yeah, they're just getting decimated. I mean, to have it revenue down $1.2 billion, that's crazy for this airline.
Yeah.
You were going to say, sorry?
Yeah, and to have revenue of $1 billion and then a loss of almost $3 billion. That's crazy.
Yeah. It shows you how many expenses there are, right?
Yeah, just so many ongoing expenses that are relying on revenue to be near normal levels to maintain. Yeah. It doesn't take, I mean, obviously in this circumstance, there's been a big drop in their revenue, but for these really capital intensive businesses, even a small drop in revenue can often lead to these companies starting to lose money. It's the kind of business that typically when you go through a recession, they will be losing money for a couple of years, even if they're, it's just sort of a regular recession and their revenue's down 30% or so or whatever. But in this circumstance, they're getting slammed just because of the complete or a substantial amount of shutdown of their flights internationally and domestically.
Yeah. And for those that aren't super up to speed with the whole looking at financial reports and that sort of stuff, essentially what we're saying is when it comes to like the income statement, the top line is the revenue. So that's where you start. That's the total amount of money coming into the business. And that was at 1.2 billion. And then the job of the income statement is to show you step by step all the different categories of expenses that the company copped in that quarter. And then you're left with the bottom line, which is the net income. So essentially, the revenue came in at 1.2 billion and then the net income came in at negative 2.81 billion. So they've got that just a huge amount of expenses that they were unable to trim, which caused their revenue to be completely sucked away, plus more, which led them to have that $2.81 billion loss. So, yeah, it's pretty nasty. I'm reading here, Delta CEO Ed Bastian said in a statement that the quarter's results illustrates the truly staggering impact of the COVID-19 pandemic on our business. You're not wrong there, Ed. You're not wrong.
At least he's not coming out and being like, look, this was a bad quarter, but we're on track to meet our targets.
We're on track to meet our pre-COVID guidance.
I don't know about you, but nothing bothers me more than when a quarter is really bad and there's an obvious reason why, and the CEO just dances around it and just distracts from it and doesn't sort of just say, look, this is what happened. This is how we're dealing with it. It's surprising how many CEOs just kind of try to just avoid talking about what's obviously happening in the business.
That's what we always say, isn't it? If a CEO starts sounding like a politician, then just run.
Yeah, politician or sales rep or a combination of both.
Sales rep, exactly. Yeah. I mean, at the end of the day, the CEO is the top dog manager of the company, and we as the shareholders are the owners of the business. So, I mean, you want the top dog manager to tell the owners of the business exactly what's going on. You want to tell them what the successes are, what the failures are, what the challenges are. But more importantly, you don't want them to shy away. You want them to be open and honest and tell you the truth and tell you their plan of dealing with the challenges. That's the thing that I love about reading, Warren Buffett's letters and all that, is that he doesn't shy away from saying where the business was struggling or failing. And very commonly, he puts it on himself and he says, look, I'll take responsibility and this is what we're going to do about it. This is how I envisage we're going to dig ourselves out of this little challenge that we're facing. Same with Elon Musk and Tesla. I mean, say what you want about Elon, but when it comes to reporting what's going on within that company to the shareholders, he's very open and honest. I mean, when the Model 3 ramp was really struggling, he said, look, I can't shy away from it. We are struggling to ramp up the production of this car. And the reasons for that is A, B, C. And how we're trying to fix A, B, and C is through X, Y, and Z. So yeah, those definitely you want the CEO to be honest. I mean, that's just so important. And if they're not, just just don't bother investing. Just get the hell away from that company. Seriously.
Yeah, because I mean, as an outside shareholder, we're not in the company. We don't know what's going on a lot of the time. So we're relying on the management team to tell us and be honest about it. And if they have a history of not being honest or dancing around what the real problem is, then how can you trust them when you really need to rely on them? When you're wondering what to do, whether you should be adding more to a stock or selling and getting out of a position, you should be able to trust what's coming out of the CEO and the other managers' mouths. But yeah,
definitely.
Bit of a rant there.
Yeah. But no, it seems like Ed Bastian, he's been pretty open and honest through this whole situation.
Yeah.
I mean, he came out and he was very open and honest, saying how that when they were losing, what was it, so many millions of dollars each day?
Yeah, something ridiculous.
I mean, most CEOs would just not say anything. They would just keep those cards close to their chests. We're like, oh, we're struggling, but we'll see. But he just came out and said, look, this is the situation. This is what it is. People need to know.
Yeah. But, I presume they've been raising a substantial amount of equity and debt in order to
I was
maintain themselves?
just reading this next part of the article. It says here, over the last year, the company has lost over 11 billion in revenue, but raised nearly 15 billion in financing, which includes 5.4 billion in loans and grants from the US Treasury.
Oh, right. Okay.
In return, Delta agreed not to furlough employees if necessary until October the 1st. So, yeah, they've copped quite a substantial hit to their revenue, but they've also raised a lot of money. In the meantime, Delta says it had 15.7 billion in liquidity at the end of Q2 with an option to borrow an additional 4.6 billion from US taxpayers. I'm sure the US taxpayers will be very, very appreciative of that.
Oh dear.
Yeah.
It's a big
bailout. Air carrier Yeah, exactly. Yeah. The air carrier posted total adjusted revenue of 1.2 billion, representing a staggering 91% dive from the comparable period a year ago. Yeah.
Wow.
Although, I know that's a staggering number. That's a 91% dive. That's what I'm saying. Revenue of just 1.2 billion, like that sounds like a lot, but when we're talking about a company like Delta, it's like, holy moly, that's not a lot.
My goodness, 91. Yeah. I think that's probably the worst I've seen, just from the reports that I've looked at and stuff.
Well, that's the problem. There's just no flights. It's just that's their whole business. It's just flying people, and this is just not happening. But in fact, that's not entirely true, because Ed Bastian, I was just reading a little spiel from him in I think Yahoo Finance live interview, and he was saying that things are starting to improve, although the improvement is very modest. So they're now carrying 20% of their pre-COVID customer load, whereas in April they were only carrying 5%.
Right.
So
interesting.
So yes, 20% is not a lot, but it's better than 5.
Yeah, this is interesting, because in the first quarter results, we were seeing that January and February, the first 2 months, were pretty normal, and then March was terrible. And it seems like in this quarter, April was maybe even worse than March. And then there's been a little bit of improvement. So it'll be interesting to see if that's true for other businesses as well. I think it probably is true. The US has been a little bit more opened up than Australia, at least, I think. So maybe some businesses are in the later months in this quarter are maybe able to start to see some improvement, but still carrying 20% of their pre-COVID customer load is not a lot. I presume they probably wouldn't be profitable even at 20%.
The funny thing, I had no idea that this was the case, but I was listening to a TED Talk with Bill Gates from about a week ago. I watched that like 2 nights ago. And it was very interesting, because Bill was saying, because he's totally across all of the numbers, all of the research, all of the potential solutions with COVID, because that's just what he does with his
foundation.
Foundation. That's what I'm looking for. And he was saying that people are thinking that it's going to be very bad to travel on an airplane, but it's actually not. It's not particularly unsafe at all traveling on an airplane, as long as you're wearing a mask, because he's saying the thing with the coronavirus that they're finding is that the reason that it's so contagious is because it's contagious in a stage where people don't even realize that they've got it, because they're asymptomatic. And the other thing with COVID-19 is that while a lot of viruses or whatever cause you to start coughing, coronavirus really doesn't cause a cough. So what he's found reading through the research on coronavirus is a lot of people that don't know that they've got it because they don't feel any symptoms are still spreading it just through, heavy breathing or laughing or sneezing or just normal kind of human actions. Like if they're in a group of friends and, you laugh pretty loud, then that spreads the disease across the table kind of thing.
Like sharing drinks or something like that.
It's sharing drink. Yeah, anything like that. So he was saying it's actually not to, like, if you were on an aeroplane, if everyone was wearing a mask, then it actually wouldn't be too bad at all. But of course that may be the case, but I guess the real question is whether consumers or passengers are up to flying again, which is a whole nother case.
Yeah, exactly. Interesting. So was that a TED talk by Bill Gates?
Yeah, it was a TED talk. It went for 43 minutes. I was considering watching it and I was like, oh, whatever, I'll just watch it, help me try and fall asleep or something. And I ended up wide awake listening to the whole thing because he's got so many insights. It's really, really interesting. He talks about the potential, vaccines and how they're coming along and when he thinks they're going to come in and the manufacturing behind them and whether he thinks, is the US going to just hoard vaccine or is it actually going to get around to the world that, the other countries that don't have the manufacturing power of these vaccines and that sort of stuff. So it was really interesting. Yeah. You can tell this guy is an expert when it comes to this sort of stuff.
Yeah. I'll have to put that on my list. I'll have to go check that out after this.
Super interesting.
Yeah, for sure.
Yeah.
In other sort of struggling business news.
Let's just keep them coming.
So Carnival,
that is going to be like the story of the next 3 weeks. Keeping on with that trend of struggling businesses.
And here's a good business. Oh no, yep, revenue down 70%. Oh.
Anyway,
so Carnival Cruise Line, of course, the cruise line and the cruise lines have been struggling more than the airlines, but those two industries have been watched very closely just because they've been hit so dramatically by all of this. But Carnival raised this week, they raised another $1.3 billion to try and keep their business going. And that debt is due by 2026, so it's due quite a fair way out. But the interest rate on this debt is kind of hilarious, 10.5% yearly interest.
Wow.
Which is, if you have a credit card, you're probably paying 16%. Maybe 26% or something. Okay, so maybe a substantial amount more than that, but 10% interest is a lot.
That's a lot. That's insane.
That's a lot. 10% interest on $1.3 billion, $130 million in interest just on that debt. And there's some other debt that they have we'll talk about.
Well, there's other debt they took on earlier on in the year at 11%. So
wow, yeah,
they keep stacking it up. And this is like I've made a couple of videos around this, and you know how everyone's just jumping on because the stock price went down like 60 or 70 or 80% or something. Oh, it's a buy because everyone's going to cruise. Cruising's not going to go away. Just buy the cruise lines. Yes, it makes sense. All right, maybe cruising won't go away. Maybe they people will go back to cruising as soon as they possibly can. But I mean, you can't forget the fact that these guys are now taking on enormous debt loads. So if you're a long-term shareholder, I mean, the next few years are just going to be repaying debt.
Yeah.
I mean, they have to take on this debt. It's not like they just take it on, that saves their business, and then that's that. I mean, they have to give it back.
Yeah, and the creditors who are supplying this debt, the people who are lending money to Carnival, they're all in line ahead of you as a shareholder. All of them. Yeah. They get paid before you. And if there's nothing left for you, then that's just the nature of being a shareholder. And I think there's still a very good chance that this business, or at least, some businesses, big businesses in the cruise line industry and even the airline industry, that just cannot make these debt payments. And even if they can, as you said, they'll be paying this back for a very, very long time.
Exactly.
Which means that there's a very limited opportunity for you as a shareholder to receive dividends. And if they are paying dividends and they're using more debt to finance that, that's even more insane.
Ouch.
And how are they going to reinvest to grow their business? They're even shrinking their business. They've been putting up, they sold 12 cruise ships, and then they've got others on collateral against debt. So if they can't pay that debt, those ships go as well. So I mean, the interesting thing about this story was I saw this story and I thought, well, I felt like it wasn't that long ago that Carnival was raising debt and in the news. So I went back onto their investor relations page, and it turns out 16 days ago they raised $3 billion.
Yeah, that's about right.
So I thought maybe it was a couple of months ago, and I just kind of I thought it was more recent than it was. But 16 days ago, just over 2 weeks ago, they were raising that's more money, and they've raised a total of $10 billion now during all of this, and the CEO has said that this is enough to survive another year with no revenue. So if you believe the CEO, that's obviously a whole thing in of itself. But if you believe the CEO, then it looks like they most likely will be okay, I guess. Not that that's enough for you to then go and invest in the company, as we said. It's not just about surviving. It's about whether they can survive without making their business owned by creditors that they have to pay off for the next 10 years.
That's a good point, actually. It's not just about surviving. I feel like that's the sentiment that I've gotten from a lot of people on YouTube, is just reading comments and whatnot, is that it'll be a great investment as long as it survives.
Yep.
But it's not just about surviving. Surviving is the first step, obviously, but then you got to think about the future as well. So I think that's a good point that you raised.
Yeah, I mean, of course, the minimum benchmark is that the business survives as a shareholder so that you don't lose money. But there's a little bit more to it than that. I think you have to think about what the cash flows of the business are going to look like in the future. And they're going to be substantially limited by their ability their need, I should say, to pay interest payments on this debt, which is probably, I should have done this before, but I'd love to add up the interest payments on that $10 billion of debt. It's probably insane. And then these debts are going to come due. It's not just the interest payment they have to pay. That $10 billion is $10 billion they can't pay in dividends. They have to pay it to the creditors because they needed it just to survive. So
just to survive. Yeah, exactly.
Yeah, I'm kind of shocked that so many people, I mean, I'm not really shocked, but it's amazing to see so many people talk about Carnival as being even anywhere near a potential investment at the moment. It's just, I think it's one of those.
I mean, most retail investors are just speculators, so I can kind of understand it, but it is sad to see.
Yeah, it's definitely very, very speculative at this point.
Yeah. Yeah, that's it. Just watch the cash flow. Think about owning the whole business, like what you and I do with our investing strategies. You just got to, even though you don't, think about you do. As a shareholder, I've bought this entire business, and then think about how much cash that business is going to make for you as the owner of the business. So you take things like your operating cash flow and then factor in all of the expenses and paying back the debts and blah, blah, blah. And then see after all of that what you're left with. And that's the way to go about it.
Very, very sound advice.
Anyway. Poor old Carnival. Jeez. I mean, I to be honest, like I like businesses like, Disney or Carnival, where really their product is just trying to make people have a good time. I mean, I kind of like businesses where they're in the business of making people happy, holidays and, enjoying yourself. So I don't like to see, cruise lines struggling, because at the end of the day, cruise lines are awesome. Cruises are awesome. They're so much fun. But it's just the nature of stonks.
The nature of stonks. That can be the title of today's episode.
Yeah, the nature of stonks. I should write a book. That should be a title of a book. The Nature of Stonks with Hamish Hodder with Brandon Vandercock. Anyway, poor old Carnival. What should we talk about next? Here's a more fun,
vibrant,
news
uplifting
topic to talk about. Sorry?
Vibrant, uplifting.
Vibrant and uplifting. A Victorian couple are a cool $80 million richer after claiming the state's biggest ever lottery prize. How nice is that?
Wow. So heartwarming.
It is. Imagine just running it. Imagine just walking into $80 million. Seriously, that's just it'd blow your mind. Imagine like your first feeling after you look at that ticket and you realize you've just won $80 million.
Yeah, it's
like, whoa.
Can't come back from that. That's peak.
My fingers are tingling.
Oh dear. Oh dear. Yeah.
It's pretty insane.
Yeah. So
What is it? Oh, so I'm trying to read. That's the thing. The woman was very surprised when, first of all, her first ticket was a bust, but luckily she bought 2 tickets. And she was very surprised when she looked at her ticket and it said 33, 2, 32, 31, 28, 21, 26, and 12. Oh, amazing. But you know what? When I read that in the article that I was reading, do you have to get 1, 2, 3, 4, 5, 6, 7 numbers correct? And then the last number has to be your Powerball number as well?
yeah, to win the jackpot. Yeah.
Holy smokes. I mean, surely like people look at that and does no one just say, I have to get 1, 2, 3, 4, 5, 6, 7 numbers correct. And then after those numbers are correct, the last number has to be my Powerball number.
Yeah. Yeah. There's definitely a key lesson here. It's don't buy 1 lotto ticket, buy 2. Because
Why stop at 2? Obviously, the lesson is the more lotto tickets you buy, the higher your chance of winning.
yeah, you could just buy.
So really,
You
need to buy as many as possible.
$79 million worth of lotto tickets. There you go.
You know, I think the economics have been figured out that will likely not win you the lotto.
No, Brandon. 100%.
Have you seen that Mr. Beast video where he buys
Scratchies?
like $100,000 of scratchies or something?
Yeah, and
I think he wins like 50 grand or something.
yeah, he got a substantial amount back, but it was nowhere near what he
I
spent.
think it was like half back.
yeah,
about half back.
I think so.
But that kind of gives you a little bit of insight into the economics and the maths behind it. I mean, he's bought a very large sample size and $100,000 worth of tickets, and he's gotten only half of it back. So it shows you that they just try and make about 50% on their prizes, on their operations, I guess.
Yeah, it's kind of like going to the casino where they have their 2 to 5% edge in every game in a small sample size. When you just play one game of roulette or something, there's a chance you can win. But if you're there consistently, that's when the economics of it, when you have a big sample size, like Mr. Beast doing $100,000 worth of scratchies, that's when you start to see how terrible the economics is for the player.
Yeah. Yeah, I kind of feel like the saying "the house always wins" is a saying for a reason.
Yeah.
Someone just didn't make it up, and someone else said, "Oh, that sounds like a good saying."
Oh dear.
Sounds like there's actually some truth in that saying. Anyway,
have you? When's the last time you bought a Powerball or a lotto ticket?
I've never.
You've never bought one? Yeah,
no.
I don't think I've ever bought one. I've been gifted one for like a birthday or something, but I've never bought a lotto ticket.
I think my parents bought one once, but that was it. I mean, to be honest, I just have no interest. I mean, I just know the probabilities, so it's just not appealing in the slight. Like, I've never gambled at all, really, except for the arbitrage stuff I did way back when. Hashtag go and watch that video on my channel, my most viewed video. Still, that's so embarrassing. A channel talking about stock market investing, and the most viewed video is about arbitrage sports betting. Anyway.
That's a nice picture of what most people are interested in.
Yeah, I know. Anyway, good on you, Victorian couple.
Well done.
Enjoy your 80 million. If you'd like to sign up for Sharesight using our referral code,
using 1,000 different accounts, then go ahead.
Then that we'd appreciate it. Anyway, moving on. Here we go. If Job Keeper and Job Seeker weren't enough for you, well, now you can have Job Trainer. That's right, a new initiative by the Australian government. We don't actually have the exact details of this today at the moment because we're recording on a Thursday and it's supposed to be announced later today. However, what the articles read so far is the PM is set to announce the expanded wage subsidy today, which is set to be the first element of the second phase of recovery after JobKeeper is phased out in September.
Right.
So apprentices will have their pay covered by the Morrison government, and school leavers offered free training under a $2 billion investment to help support Australia's COVID-19 recovery. The fate of the $1,500 a fortnight JobKeeper subsidy is set to be announced next week in a major economic statement, with the Prime Minister flagging ongoing support for some industries, including Qantas. So that's interesting. I guess watch this space. Maybe they've changed their tune and they're going to come out and help the airlines all of a sudden. But that was interesting. The expanded apprentice wage subsidy, to be announced on Thursday today, will now cover half the pay up to 180,000 eligible apprentices until March 2021, up to a maximum of $530 a week. So there you go.
Interesting.
It seems like they're just trying to scramble to keep some level of support going after the current things that are in place have expired. But
right. So are those? I haven't been keeping up with this really much at all.
Nah.
Are they expiring? Are they set to expire or have?
The government's come out a couple of times and said that the money that they're giving under this JobKeeper allowance is definitely going to stop in September.
Right, okay.
But obviously they've been hit with so much pushback. I've been seeing just absolutely everywhere at the moment, people just hounding the government, just saying, this is crazy, it's not enough, you need to keep this going. So maybe this is a way to kind of half transition out of JobKeeper and half transition into something new, which is just focusing on people that are really struggling or something. I don't know. I don't really know. Yeah. We'll have to wait and see what they announced today, to be honest.
What I find interesting is that all these articles are always like, they're set to announce this, and then they explain partly what it is. And
what it is.
It's like, how do they know? It hasn't been announced yet.
Yeah. I don't know. Yeah, I don't know. I don't know enough about media and journalism to understand how they get that insight from actually genuinely reliable sources, or are they just guessing?
Yeah, I don't know. Maybe we can we'll give a bit of a quick update on this next week after we know what's happening with it.
Yeah, for sure.
All right.
In other news, we've got one more news story to cover. Atlassian's Mike Cannon-Brookes says clean energy is the best opportunity for a COVID-19 rebound, which is pretty interesting. Yeah, so it says here the tech billionaire and climate warrior Mike Cannon-Brookes says there's never been a more compelling time for Australia to adopt clean energy, and believes Canberra is starting to listen. As governments grapple with quick ways to create jobs and stimulate activity, Atlassian co-founder Mr. Cannon-Brookes said masses of large-scale renewables projects are shovel-ready.
Right.
He says, we've lost about 800,000 jobs so far in the last 4 months. The plan that he's talking about has 1.8 million jobs we can refill them with, which we can move forward with pretty much straight away. So he's referring to the 1 million jobs plan that was launched 2 weeks ago, I think, by the climate-focused think tank Beyond Zero Emissions. So, yeah, I think the renewable energy proposal is to build 90 gigawatts of solar and wind energy backed up with new transmission infrastructure and 20 gigawatts of battery storage. He says the best opportunity we've had for large-scale job creation in the Australian economy today. And so we've been broadly sharing the plan and trying to get as many people across and behind it as possible.
Right. Okay. So they're saying that there's a good opportunity to expand renewable energy and provide a lot of jobs for people.
And create jobs. Yep, that's exactly right. Yeah. So I think there's this group called Beyond Zero Emissions, and of which he is a part, and they've kind of thought up and created this 1 million jobs plan, which they're trying to, Mike Cannon-Brookes is going and trying to present this to politicians and actually explain it to them and say, look, this plan actually makes a lot of sense. Like, we're losing a lot of jobs. This refills all of those jobs plus creates even more jobs. So can we get this thing started? We know we have to transition to renewable energy anyway. So it seems like it's just a win-win-win. I mean, there's job creation, there's obviously massive construction of renewables and battery storage and that sort of thing. So it seems like it's a good plan. Like, I don't know how much it's going to cost, but yeah, I mean, why not?
Yeah, I mean, it would certainly be good to see more of a push towards some renewable energy options and just more investment in that area, I think. There's probably things that we will try, just people in general will try in renewable energy, and some of it will work and some of it won't work, but it needs to be consistent investment in that area to for there to be innovation so that we can get to a point where we find a good renewable energy solution that's sustainable over the long term. So yeah, this is always a positive thing to see. Do you know how big that that battery was? You saw it said build 90 gigawatts.
Yeah, the one in South Australia.
One in South Australia. How big was that one?
Hornsdale Power battery. I'm going to have a look. Battery.
Because this one, they said they're aiming for a 20 gigawatts of battery storage.
Yeah, I think that's not one that's going to be many batteries.
Yeah, true. Yeah.
Storage 185 megawatt hours. So
right, okay.
185, I think.
Yeah.
The lithium ion battery. Yeah, so it's going to be many projects. But I mean, now's the time. I definitely agree with you. I'd love to see more large scale investment. I mean, this is always the thing that I come back to, and I know I just said it before, but I'll say it again, is that we have to do this eventually. Like, it has to be done. It's not like we can just keep burning oil and coal and whatever forever, you know. We have to make the transition. So if we're staring at a plan where, you know, it's a big infrastructure investment, but at a time where there are 800,000 Australians that are now struggling to find, you know, work, and we've got this plan that exists where we could create 1.8 million jobs, and it's something that eventually we're going to have to do anyway. Is it not the time to just pull the trigger and move forward with it? I mean, to me, that seems pretty logical, but yeah, I don't know.
Seems logical to me.
Then again, Australia is run by the mining lobby, so we'll see what happens.
Yeah, that's what I was thinking. We're probably going to be, I wouldn't expect us to be, I guess maybe I should say it like this. I wouldn't be surprised if we were slow to move on renewables just because of the government's close relationship with the coal industry. And that's all I'll say.
Very close. Very close. Have you seen the Greenpeace video where it links the Liberal Party and the Murdoch media and the mining lobby? Have you seen that one?
I've seen that, yeah.
Oh dear. Man, that is an eye-opening video. If you haven't watched that video, just search it on Google, Greenpeace. I don't even know what to type in. Australian government coal mining, and it'll come up for sure. It is quite scary, the ties that the government and the mining lobby and the Murdoch media have with each other. Yeah, that's all I'll say. Anyway,
should we move into some Q&A?
Yes, definitely. Let's do it. We got a few questions from last podcast, I believe.
Yeah, we've got a couple here. And as always, guys, if you have any questions, then the same as if you have any earnings suggestions, then head over to the YouTube version and just leave your questions on the latest version of the podcast. So just click the latest one. And if you can keep them nice and short and sweet, that makes our lives a little bit easier as well. Should I read one of these to you?
Sure, go for it.
So I'll read this first one to you. Would it be incorrect to refer to Berkshire Hathaway as an ETF, an exchange traded fund, given their diversity of businesses under a single umbrella?
Yeah. Yeah, it kind of feels a bit like that these days, doesn't it, with Berkshire Hathaway? Yeah. They've just got so many wholly owned businesses in different sectors, and they've got obviously significant stakes in other public companies in a lot of different sectors that you kind of get a little bit of everything. But obviously it's not going to act like, say, a market tracking ETF because, you know, I don't even know how many businesses Berkshire has stakes in or owns completely, but I would guess that it wouldn't be more than, I don't know, what number would you put on it? Maybe 50?
Yeah, I'd say probably less than that, but more. I guess more. I think the important thing is that there's a lot of concentration in just a couple. They do have quite a lot of smaller businesses relative to their other positions, that is. So they do, if you look at what industries they're in a lot of industries, which probably covers most of the industries that, say, the S&P 500 would cover, but they're concentrated in a couple of industries like Apple, for example. They have a big concentration in Apple. The insurance industry, their insurance business is huge. Energy. So, yeah.
Yeah, it's true. I'm just looking at the Berkshire Hathaway portfolio at the moment. Yeah, they have 50 stocks in that portfolio, but once you go past 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So there's only 15 stocks that have more than a 1% value in the portfolio.
Right. Yeah.
So 15 plus however many they actually own. Even if you look at the chart of wholly owned businesses, there seems like there's quite a few, but there are only a few that are really significant for them though.
Yep.
Like for instance, like Geico, their insurance company and that sort of stuff. So Berkshire Hathaway Energy and those sort of companies. So yeah, you're right. It certainly wouldn't act perfectly along with the market like what an ETF would. I mean, at the end of the day, like an S&P 500 ETF, there's 500 companies in there. So it's going to act very different. But I totally get where you're coming from with this question because yes, you're right. They do have a lot of businesses in a lot of different industries and they are pretty decently diversified.
Yeah.
But yeah.
Yeah.
All right, next one here. How do you both go about expanding your circle of competence, if at all? Or is it just kind of random? How do you go about expanding your circle of competence?
Well, firstly, very slowly. Typically, I mean, if I'm ever looking, sometimes I guess maybe I'll explain how do I go about it. Well, it'll generally be areas that I'm maybe newly interested in or areas I was previously interested in, but I just sort of didn't look into before. And if I'm ever looking into a new business that I haven't analyzed before or a new industry that I don't really know too much about, usually I'll leave myself at least 6 to 12 months after I've first learned about it before making any substantial investment. So sometimes I'll have a little bit of a nibble at a business if I've done an analysis after like say a month and I think it's a really good business, but I'm not super confident in it because it's been a month. Like I haven't really seen how that industry changes or I haven't learned too much about it. So usually I'll wait a substantial amount of time, but how do you go about it? A key part of that would be, I guess, reading the annual reports for as many public businesses that you can find in that industry. That'll give you a nice idea of how businesses operate the same in that industry and how they operate differently. Like in a restaurant industry, there's obviously things that are the same, but there's different types of restaurants. There's franchises and company owned and a little bit of both and a master franchise. So there's different ways that businesses can operate within that industry. And by learning about different businesses in that industry, you can get a more of a complete picture of how that industry operates.
Yeah, and the other thing that I would add to that is don't force it. Don't force yourself to try and expand your circle of competence because at the end of the day, your circle of competence, it really does tie back to like what your interests are because what you're really interested in are the companies that you're going to be able to research in that kind of depth and get that next layer of understanding. So I guess I wouldn't try and force it. That's what I would probably say. So yeah, when you say you do it very slowly, then yeah, I totally agree with that. But yeah, I guess it just comes down to finding different things that you're interested in, and what you said before, reading your different annual reports, and then you find other things that pique your interest throughout that process. But yeah, I think if you ask this question to Warren Buffett, he would basically just say, look, you don't have to expand your circle of competence. I mean, you don't need to understand the world. You just have to understand a few things very, very well. So, for him, it might be like banks or insurance or that sort of thing. So, but yeah, generally speaking, I just let my circle of competence slowly grow with as my interests kind of change and over time, I guess.
Yeah. All right. I'll ask this one to you. Hey guys, great job on the podcast. Thank you very much.
Thank you.
Can you please share your thoughts on gold and silver as an investment?
Yeah, we're going to say the exact same thing on this one. I got no problem with gold and silver. And I mean, you look back in time, historically, turbulent markets, people go into gold and price of gold goes well and yip-de-doo. But at the end of the day, just gold, it just doesn't do anything for you. I mean, it's the same as buying, gold, silver, Bitcoin, trading cards, collectibles, whatever. At the end of the day, those investments, they don't produce you any money. So what you're relying on in those investments is that eventually you're going to be able to sell them to someone that wants to pay a higher price than what you paid. But there's nothing about that thing that makes it worth more. I mean, for instance, even if you just look at the example of collectibles, I mean, it's just a bit of plastic at the end of the day. You're just hoping that one day you're going to sell that bit of plastic to someone that wants it more than you did and is willing to pay more for it. Whereas a company, when you're investing in a company, it grows its earnings over time. You know, it's got growth avenues, it builds its business, it becomes more valuable as an entity over time. And that's why share prices go up over time. And that's why eventually you can sell your shares for more, because the company has grown and its cash flows have grown, and therefore that company is worth more to the investor. So that's why I like looking at businesses, and that's why I don't really look into gold and silver.
And that's a great answer, and I have nothing more to add.
No, nothing to add. Well, yeah, I totally knew that we were going to say the exact same thing leading in.
Yeah.
That we've said that on the podcast a couple of times before, I think.
Yeah, if it doesn't produce cash flow, I don't think I can get to a confident estimation of what I can get back from it.
Of what it's worth. Yeah, exactly. Yeah. All right, should I ask this one to you?
Yes, let's do it.
All right, sure. How are we going for time? Oh, yeah, we might finish up on this question, maybe.
Yeah.
All right, this question says, hello guys, do you think the European or Australian markets have a chance of outperforming the US market in the next 10 years since they have underperformed it for a long time?
So, I mean, I think yes. If we look back at like 100 years of data for the Australian and the US markets, the Australian market's done fairly well over time. I think there was a report that said that the Australian market had delivered something like 13% per year over the past 110 years or 100 years or 90 years or something like that.
It's 100. Yeah, it's like 110, 115, 117 or something like that. Yeah, it's returned 13%.
Which is insane.
It's pretty unreal.
Yeah. So if you're looking over a very long period of time, the Australian market, I don't know about the European markets, but the Australian market has held up quite well. That's more recently, I think the US market has done a bit more outperforming in the last 10, even 20 years. But in terms of whether they have a chance of being outperforming the US market over the next 10 years, I mean, there's certainly a chance. There's certainly a good chance, I think. But is that something that I can predict or predict what's going to happen? I'm not sure. Maybe you can. Maybe you could look at maybe if you thought one was more overvalued than the other one, then you could maybe believe that or reach an argument that the undervalued one should perform better over the next decade. But that's not something that I would consider in my investing. When I'm investing in the Australian market, if it's an individual business, I'll do the cash flow analysis. I'll figure out what I think I can get back from it and then figure out what price to pay. And in the ETF, in the index fund that's just tracking the Australian market, I'm just happy to come back every now and then and buy more of it. And if it does anywhere near as good as it did over the last 100 years, it may not do that. But even if it does 6, 7, 8% over the next 50 years or so, that will grow very well, much quicker than if you have your money invested in something like a savings account. So that's kind of the extent of my thoughts on that. Do you have any thoughts on that?
Yeah. I think when it comes to, will the Australian or European markets outperform the US market? I think you're kind of just making a guess. I mean, yeah, like you said, maybe you're an expert and you've really dug in deep and you understand the economics of both countries and you understand the valuations of the current markets and I don't know. But the way I just generally tend to look at it, and this is just a guess, I tend to guess that the US market will outperform the Australian market. And the simple reason for that is that the Australian market is basically just holes and homes. It's just mining or banks.
Holes and homes.
And when you look at Australia, like our second largest export is coal, and that's just going to tank. So I don't really like our chances. When I look at the States and I see that, the major tech innovative companies that are really leading the charge into the next kind of 2-3 decades, when I see that all of those kind of innovative companies are based out of the United States, then I tend to kind of think that, maybe the US is going to do do much better than a company that's still clinging onto a resource that isn't even going to be used in 10 years' time. So that's just my general thoughts on the matter. And especially because we've got a government that is just not looking to try and change that anytime soon. So that's kind of my thoughts. So I would tend to guess that the US market would, in the long term, would outperform the Australian market. But in the short term, like, who knows, because the US market's so overvalued, and it's certainly more overvalued than the Australian market. So maybe the US market cools off and the Australian market just keeps chugging along, and maybe that means that we outperform it. At the end of the day, I'm just guessing. So that's kind of my input. I hope that helps.
Yeah. All right. Well,
anyway,
should we leave the podcast there for today?
We shall. Thanks everyone for sending in your questions. That was really good. I like those questions. And make sure if you do have another question, or ask us anything. If you have a news story you want us to cover or something you want us to talk about, then just drop us a comment on the most recent podcast that is up on our YouTube channel, which is youtube.com/The Young Investors Podcast. Or is it The Young Investors Podcast, right?
The Young Investors Podcast.
Yeah, cool. But yeah, man, we've been struggling a lot with that URL.
It's caused more trouble than
what it's worth. I know. It would have been easier if we just YouTube/channel/XY !! Anyway. Make sure you head over there if you want to ask a question or give us some inspiration of something to talk about. But other than that, thanks Hamish for joining me for today, as always. And thanks very much for listening, guys, and we'll see you guys next week.
See you guys.